If you look carefully at economic history, you'll see a pattern that has repeated for centuries. There's a specific moment in economic cycles where keeping money idle isn't just a bad decision. It's a decision that can destroy decades of hard work. We're rapidly approaching one of those moments in 2026. This isn't a prediction. It's a logical consequence of the cycles that govern our economy. Today, I'm going to explain why keeping your money under the mattress in traditional savings accounts or even in CDs could be the worst financial decision you can make over the next 2 years. And more importantly, I'm going to show you exactly what to do about it. History is an excellent teacher, and it's screaming a warning that few are hearing. Let's start with a simple truth. Money is an illusion. I don't mean this philosophically. I mean this practically and measurably. The dollar you have today isn't the same dollar you had in 1980. It's not the same dollar you had in 2000, and it definitely won't be the same dollar you'll have in 2030. If you had kept 100 zalauzen under the mattress in 1980 today, that money would have the purchasing power equivalent to just 30 zalauzen. Not because the money disappeared, but because the real value of money was systematically eroded. This is the first cycle. You need to understand the cycle of monetary debasement. Every time governments face crisis, wars, pandemics, deep recessions, they do the same thing. They print more money. It happened during the Great Depression. It happened during World War II. It happened in 2008, and it happened massively during the 2020 pandemic. Between 2020 and 2022, the United States printed more money than in its entire previous history combined. Think about that for a moment. More than 240 years of American monetary history were surpassed in just 2 years. The consequences of this action are still unfolding, and 2026 will be the moment when they become impossible to ignore. To understand why 2026 is crucial, you need to understand how the economic machine really works. Imagine the economy as a giant clock. Each gear represents a different element: productivity, credit, inflation, employment. When all the gears work in harmony, we have stable growth. When a gear breaks or accelerates too much, the entire system goes in imbalance. Over the past 4 years, several gears have been forced to accelerate artificially through monetary and fiscal stimulus. The credit gear was accelerated with interest rates near zero. The consumption gear was supercharged with direct stimulus checks. The liquidity gear was turbocharged with asset purchase programs by central banks. Now we've reached the moment of adjustment. And in every historical adjustment, there's a simple rule. Real assets preserve value. Paper money loses value. By real assets, I mean things that maintain their fundamental utility regardless of how much money is printed. Shares of productive companies, real estate, commodities, precious metals. By paper money, I mean bank deposits, low-yield fixed income securities, and physical cash. The difference between these two categories is going to become brutal in the coming years. Let me explain inflation in a way you may have never thought about before. Inflation isn't just rising prices. Inflation is the systematic transfer of wealth from those who hold money to those who own assets. Here's how it works. When the government prints money, this new money doesn't magically appear in your bank account. It enters the system through the banking system and financial markets first. Those who are close to this source of new money banks, large corporations, institutional investors, can use this money to buy assets before prices rise. Those who are far from this source use salaried workers. Retirees on fixed income only feel the price increases without having had the opportunity to protect themselves. This process has a technical name, the Cantillon effect, named after economist Richard Cantillon, who identified it in the 18th century. But you don't need to know the technical name to understand the practical effect. When you keep money idle during inflationary periods, you're effectively donating your wealth to others. Now let's look at concrete numbers for 2024 to 2026. Even with official inflation around 3 to 4%, real inflation, the one you feel at the grocery store, at the gas station, and rent, is substantially higher. Housing has risen 25% in the last 3 years. Food has risen 20%. Energy has risen 30%. If you kept 100,000 idle during this period, you effectively lost to 20,000 to 25,000 in purchasing power. And the worst is yet to come. If you understand incentives, you understand behavior. The incentives for 2026 are creating a perfect storm that will make it extremely expensive to keep money idle. First incentive, American national debt has surpassed $33 trillion and is growing exponentially. The service on this debt, just the interest already consumes more than $100 trillion per year of the federal budget. This means that even without creating new programs, the government needs more and more money just to pay interest on what it already owes. How does the government get this money? By printing more dollars. Second incentive, the aging of the American population is creating unprecedented fiscal pressures. Every day, more than 10,000 Americans turn 65 and become eligible for Medicare and Social Security. This phenomenon will continue for the next 15 years. The result, mandatory spending that grows automatically regardless of political will. Third incentive, geopolitical competition with China and Russia is forcing greater military and infrastructure spending. No matter which party is in power, these expenditures are considered essential for national security. Fourth incentive, the banking system is facing a silent crisis. Hundreds of regional banks are sitting on massive losses in their bond portfolios purchased when rates were low. When these losses become realized, and they will, the government will have to intervene again. All these incentives point in the same direction. More money printing. And the more money is printed, the less valuable becomes the money you have sitting idle. Let me tell you the story of two families during the 1970s, a period that shares many similarities with our current situation. The Martinez family and the Thompson family were neighbors in suburban Chicago. Both had savings of $50,000 in 1970, a substantial amount at the time. The Martinez family decided to keep the money safe in a savings account, earning 5% per year. It seemed like a good decision. After all, it was a solid return with no risk. The Thompson family, influenced by an uncle who understood economics, split the money between stocks, real estate, and precious metals. It seemed riskier. Fast forward to 1980, the Martinez family had $81,000 and the account growth of 62% in 10 years. Sounds good, right? But here's the problem. Cumulative inflation for the period was 112%. This means the $81,000 in 1980 bought less than half of what the original $50,000 bought in 1970. The Martinez family worked for 10 years, lived below their means, saved money religiously, and became poorer. The Thompson family, their assets grew to $195,000 in the same period. They not only preserved their purchasing power, but tripled their real wealth. This isn't a made-up story. It's the typical pattern that repeats every time we enter prolonged inflationary cycles. Now imagine a country going through a crisis of confidence in its currency. In the 1920s, the Weimar Republic in Germany faced exactly this situation. The government printed money to pay war reparations and finance internal spending. Initially, people who kept German marks in bank accounts thought they were being prudent. But as money printing accelerated, the mark lost value so rapidly that people needed wheelbarrows full of money to buy bread. Who was protected? Those who bought real assets, stocks, real estate, gold, even basic products like food and fuel. Who was destroyed? Those who maintained savings and marks. Not saying the United States will face hyperinflation like Germany, but I'm saying the principles are the same. When there's excess monetary creation, real assets preserve value and paper money loses value. Now, let's make this specific and practical for your situation. If you have 100,000 sitting in checking or savings accounts, you're effectively losing $3,000 to $4,000 per year in purchasing power, assuming 3 to 4% inflation. But if inflation accelerates to 6 to 8%, something totally possible given the fundamentals we've discussed, you'll be losing $6,000 to $8,000 per year over 5 years. This represents a $30,000 to $40,000 in lost purchasing power. Now multiply this by your specific situation. If you have 200,000, double these numbers. If you have 500,000, multiply by 5 for someone close to retirement. This is devastating. Imagine you plan to retire with $1 million in 2030. If you keep this money idle and average inflation is 6% per year, your million will have the purchasing power of approximately $750 in today's dollars. This isn't a small problem you can ignore. It's the difference between a comfortable retirement and a retirement of hardship. For young families, the impact is even more dramatic due to time. If If you're 35 years old with 50,000 sitting idle, keeping this money safe for 30 years until your retirement, even with just 4% annual inflation, that 50,000 will have the purchasing power of less than 15,000 in today's dollars. On the other hand, if you invest that 50,000 in a diversified portfolio of assets that historically outpace inflation by 4 to 5% annually, that 50,000 could become 200,000 to 270,000 in real purchasing power. The difference between these two choices is literally the difference between poverty and comfort in retirement. Based on the principles we've discussed, here's exactly what you should do. And this isn't specific financial advice. These are educational principles you can apply with guidance from a qualified professional. Never put all your eggs in the same basket, but also never leave all your eggs in the basket that's broken. In this case, the broken basket is paper money. A basic inflation protection structure should include 40-50% in quality company stocks, especially those with pricing power, 20-30% in real estate assets like rights or direct properties, 10-15% in commodities and precious metals, 5-10% in inflation index bonds, and 10-15% in cash for opportunities and emergencies. Notice that only 10-15% stays in cash, enough for emergencies and opportunities, but not so much that it gets destroyed by inflation. Not all assets are created equal during inflationary periods. The best protections are companies that can pass cost increases on to consumers without losing demand. Examples include essential consumer goods companies, utilities with index contracts, technology companies with closed ecosystems, real estate, and prime locations. Avoid highly indebted companies, extreme commoditization companies, fixed income securities without inflation protection. Cycles change. What works today may not work tomorrow. Keep at least 15-20% of your portfolio in liquid assets that allow quick adjustments as conditions change. This can include diversified funds, liquid ETFs, or even cash during transition periods. You can't predict exactly when inflation will accelerate or decelerate. What you can do is position yourself appropriately for different scenarios. Implement your changes gradually over 6 to 12 months, not all at once. If you need the money in the next 2 to 3 years, maintain a conservative reserve even if it loses to inflation. Short-term volatility can be worse than inflation. If your horizon is 5+ years, you can take on more volatility risk in exchange for inflation protection. Markets evolve, cycles evolve, your situation evolves. Dedicate regular time to understanding how your choices are working and whether they still make sense. When implementing these strategies, there are common traps I see people fall into repeatedly. Many people get so worried about making the perfect choice that they make no choice at all. There's no perfect solution. There's only better or worse than keeping money idle. Doing something imperfect is better than doing nothing. Some people discover that gold protects against inflation and put everything in gold. Others discover that stocks historically outpace inflation and put everything in stocks. Remember, the goal isn't to maximize returns. It's to preserve and increase purchasing power with controlled risk. Some people say, I'll wait for the next market drop to invest, or I'll wait for inflation to come down to get out of cash. While you wait, inflation is eroding your purchasing power every day. Any strategy must consider tax implications and transaction costs. Sometimes the theoretically superior strategy becomes inferior after taxes and costs. Implementing a strategy is just the first step. Maintaining the correct percentages over time is equally important. If stocks rise a lot, they might represent more than 60% of your portfolio when you plan for 45%. It's time to rebalance. Since we can't predict the future with certainty, we need to prepare for different possible scenarios. The most likely scenario based on current fundamentals is persistent moderate inflation of 4 to 6% annually. In this case, a balanced diversification strategy offers good protection without excessive volatility. If geopolitical or fiscal pressures intensify, we could see higher inflation of 7 to 10% annually. In this scenario, greater allocation to commodities and real assets becomes crucial. Although less likely given fiscal fundamentals, a severe recession could temporarily create deflation. In this case, having some liquidity and flexibility to take advantage of opportunities is essential. This was the nightmare of the 1970s and could return. Stagflation, which is high inflation combined with low growth, In this scenario, assets that work well regardless of economic growth, like utilities, rights, and precious metals, are especially valuable. The key is having a portfolio that works reasonably well in all these scenarios instead of betting everything on a single outcome. Now that you understand the principles, how do you implement them in practice? Do a complete inventory of where your money is today. How much is in checking and savings accounts? How much is in CDs or low-yield bonds? How much is in investments? How much is in real estate? What's your time horizon for each part? Based on your risk profile, time horizon, and objectives, define your target allocation. What percentage should be in each asset class? What's your minimum emergency reserve? What specific products make sense for your situation? Don't change everything at once. Implement changes gradually. Transfer 25% per month from poorly allocated assets. This reduces timing risk and allows adjustments based on new information. Monitor how the strategy is working. Are the percentages still correct? Have your personal circumstances changed? Are adjustments needed based on economic changes? Every 6 months, rebalance to maintain target allocations. Sell a little of what went up too much. Buy a little of what's underweight. This forces you to sell high and buy low. Let me be very clear about something. Every choice has a cost. Investing in assets has costs, volatility, risk of loss, complexity, taxes, fees. But keeping money idle also has costs. Guaranteed inflation, lost opportunities, risk of monetary debasement. The question isn't to avoid costs. It's to choose which cost you prefer to pay. The cost of inflation is silent but certain. Every month, every year, your purchasing power decreases a little more. The cost of investment volatility is loud but temporary. Some years are bad, others are good, but the long-term trend is to preserve and increase purchasing power. For most people, especially those who don't need the money in the next 3 to 5 years, the cost of inflation is much greater than the cost of volatility. But you need to make this decision consciously, not through negligence or fear. History teaches that periods of great monetary creation are always followed by periods of wealth redistribution. It's not a political issue. It's a mathematical issue. When there is more money chasing the same amount of goods and services, prices rise. When prices rise faster than returns on conservative assets, wealth is transferred from conservative savers to asset owners. This transfer doesn't happen through theft or direct confiscation. It happens through the silent but relentless mechanism of inflation. If you look carefully at the coming years, you'll see this process in action. Those who understand and prepare adequately will not only preserve their wealth, but prosper. Those who ignore this process or cling to outdated concepts of financial safety will discover that their definition of safety was in fact the greatest risk of all. True security doesn't come from avoiding all risks. It comes from understanding risks and managing them appropriately. The biggest risk of 2026 isn't market volatility. It's the complacency of keeping money idle while its value is systematically eroded. This isn't a prediction. It's a logical consequence of the economic cycles that govern our reality. The choice is yours. But choosing to do nothing is also a choice, and in 2026, it will be a very expensive choice. History will once again be an excellent teacher for those willing to learn its lessons. The question that remains is, will you be among the students or among the victims?